Welcome to the INREM podcast, where we discuss for real estate investor. Andy and Sean are both attorneys. Nothing said in this discussion should be considered legal advice. We're simply providing information and education. You should consult with an attorney in your state regarding any specific legal issue that you may have. Hey, good morning, everybody. Welcome to the show. The final Tuesday before Christmas. I hope you are enjoying your holiday and enjoy a nice Christmas. Today, we're talking about the Arizona real estate market. We're checking the temperature, finding out where it's at. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, like our channel and subscribe. You can find us on Facebook, and you can find us on YouTube. We are at INREM Podcast. That's at INREM Podcast on YouTube. With that, Sean, give us a legal update.
So our legal update today will be the 3 ways to purchase property subject to an existing mortgage. So the first way is your standard transaction, right? So that's where you purchase the property with a warranty deed. The liens remain, and then you provide the seller with a note and deed of trust that basically wraps, what we call a wrap. It wraps around the existing loans that are going to remain, so that if the buyer does not perform, the seller has a remedy, and the remedy is they can complete their own foreclosure, take the property back. So that's one. The second thing that you can do is what's called an agreement for sale. Some states call it a contract for deed or a land installment contract. And that's basically where you will not take fee title to the property, but you enter into an agreement whereby you're going to pay certain amounts over time. And so there's normally a principal amount, there's interest on that principal, and then there's payments that are made monthly or quarterly or however you structure them. Maybe there's a balloon payment at the end, but basically you agree that over a period of time, you're going to make these payments. And if you make those payments and you complete that, and the payments will result in not only performing under the agreement for sale, but those payments are going to result in paying off the loan that's remaining on the property. Once that is all paid and everything's paid under the agreement for sale, then a warranty deed is provided to the buyer, and then the buyer can take that warranty deed and record it. And that warranty deed would then effectuate the transfer of title from the seller to the buyer. But in the meantime, while the buyer is making these payments and performing under the agreement for sale, the buyer has the right to possess the property, to improve the property, basically to treat the property as their own. The only difference is they don't have an owner or a fee title ownership interest in the property. They have an equitable ownership interest with a right to obtain fee title at some future time upon their performance under the agreement for sale. Then the third way to accomplish this would be to enter into a lease agreement with the seller, whereby they technically wouldn't be a seller at that point. They would become a landlord, but it's a long-term lease that would allow you as the investor to sublet the property. So you would enter into a long-term lease. You would then have the right to sublet the property with an option to then purchase it at some future time. And so you would be looking to say, okay, it's a 5-year lease with a 5-year option to purchase. And anytime during these 5 years, I can exercise the right to purchase it. And here's the set price, or you can agree on some means to calculate the purchase price at some future time. But that's another way to basically acquire or take, in this case, possession with a right to purchase property that is subject to the existing loans. So the existing loans would remain. You would simply become a tenant. Which method you use really depends on a number of factors, right? So the first would be, what are the loans that are out there? What do you as the investor feel about the due on sale clause for that particular lender and loan? how does the seller feel about the potential that there might be a due on sale clause that's invoked, right? So if you convey property that's subject to an existing loan, if you do that, you give the lender a right. Whether they exercise that right or not is a whole different story, but you give the lender the right to basically start foreclosure proceedings or accelerate the loan balance and declare the full loan due. So you say, okay, well, maybe a long-term lease won't invoke the due on sale clause, and so I'll do the long-term lease. Or an agreement for sale is better because I'm not actually taking fee title, although that might actually invoke the due on sale clause. So that's one, is how do you feel about the due on sale clause? The second is, what is the seller comfortable with? The seller may not want to provide fee title, ownership, interest, even though all three of these have the same result, which is possession in the hands of the investor. So the investor possesses it, can use the property how they may, with the ability to purchase it. But one is an actual outright fee title purchase to the property, and the seller may be like, I'm not comfortable with that, but I might lease it for 5 years and give you an option to purchase. Or maybe we'll do an agreement for sale because of the fact that in an agreement for sale, I'm not actually giving you ownership. And if you don't perform early on, I have a quicker remedy as far as a forfeiture. So the seller may be more comfortable. And it's really you as the investor, what strategies you're comfortable employing as well. So there's a number of factors that go into which of those three you want to utilize, but those are the main three. There's some other more creative things out there that I won't get into, but those are the main three tried and true methods that can be utilized to basically take over property that's subject to an existing loan.
All right. With that, let's get into our topic today. Excuse me. We're talking about the Arizona real estate market. It is the end of 2021, and if you're like me, you're thinking, where did this year go? But the end of 2022, rather, the end of 2022 or 21 a year ago feels like just yesterday. And the real estate market, it feels like it's been an eternity. A lot has happened from the end of last year to the end of this year. A lot of questions that are out there about what is 2023 going to look like. And we're really on the heels of that. And we're going to know soon. But for you as the investor, for planning purposes and what that's going to look like, this is a big, important topic. So we thought it would be important to discuss at the end of 2022 and kind of see where we're at and what the temperature looks like going forward. With that, we're pleased to have with us Tina Tamboer here with the Cromford Report. Tina, thanks so much for joining us.
Thanks for having me.
So, Tina, you're the senior housing analyst at the Cromford Report. Tell us about the Cromford Report.
The Cromford Report is a proprietary system that is, we have an arrangement with the Arizona Regional MLS. They allow us to download MLS data every single day and do analytics on it for their members.
So how did you get involved with the report and providing real estate statistics and analysis?
Well, I moved to Greater Phoenix in 1993, and I started to work for a title company as an analyst. So I was always kind of an analyst first in the 90s. So I got to see a lot of the changes and the growth of Phoenix then, got my feet wet. Then I was 10 years in title insurance sales. And right around 2011, through my contacts in the data world, I was introduced to Michael Orr, who is the founder of the Cromford Report. He's a mathematician from Oxford and an investor as well. So he needed some help. So I left the title industry, and I've been working with Mike now for 11 years.
So it's safe to say you have, in your time in real estate, you've seen a lot of cycles.
Yes. As both an analyst and as a salesperson, I actually experienced the crash myself. So
The good, the bad, the ugly, all of it.
Yeah.
In all of its glory. Well, that's great. That's exactly the kind of analysis and perspective that we were hoping to have today. As we get into talking about the Arizona real estate market, and we're going to get into talking about that specifically, I wanted to start out with a discussion topic with recent real estate industry news out of Florida. And one of the reasons it's worth talking about, and when markets slow, when everything's great, nobody really questions too much. It's when the market's slow and everything becomes a problem that that regulatory authorities get involved and start to care about things. So a recent headline out of Florida, and I'm just give the headline here, and Sean, I'll turn to you to kind of give some of the facts about it. But recent headline: Florida pursuing real estate broker who receives 40-year listing in exchange for compensation. So why don't you, Sean, give our listeners some context behind that, when then we can discuss it.
Yeah. So in this case, and it's happened all over, not all over. There's specific states that this is happening, and this company is basically doing this. I've seen it here in Arizona, and I've actually seen the recorded documents, and had an opportunity to review those recorded documents here in Arizona. But basically, the business plan or structure of this brokerage is to contact homeowners and solicit them to be part of their program, whereby they actually compensate the homeowner. And according to this article, it's anywhere from, say, $500 to $5,000, depending on the value of the property. But they basically write a check to the homeowner and say, okay, I'm going to cut you a check today of this amount. It's yours. Do with it as you may. However, the only thing is at any point within the next 40 years, if you are going to list your property, we have the exclusive right to list that property. And they put in there that they want 3% commission minimum. However, if they find the buyer and the dual agent, then they would receive 6%. If another broker comes and presents the buyer, and so you have a co-broker, in that case, the commission jumps up to 6%. But so it's 3% minimum, upwards of 6%. And now, this isn't a listing agreement that the owner signs at the time of receiving the payment. Instead, what they sign is basically an obligation to use this broker to list the property should they decide to sell it in the future. And then at that point, they would enter into a new listing agreement. My understanding from this article is the new listing agreement would be for a 6-month term. And then this broker would have the ability to market, to try to procure a buyer for this property during that 6-month period. And then if they're not successful, it's my understanding that the listing agreement goes away. But they have to be given the ability and first right to list that for a period of 6 months. And if they don't, then there's a penalty. There's a liquidated damage provision or a cancellation clause or provision that they have, or fee that has to be paid, which is pretty sizable. I think it might even equal the 3%. But nevertheless, there's a sizable cancellation fee if they want to, list it with somebody else. So in practice, what happens is there's two concerns of this article, and then we'll open it up for more discussion. But there's two concerns. Number one, in practice, what was happening is the homeowner didn't fully appreciate what they signed, or maybe they even forgot about it. They go and they list it with somebody else. They have a buyer. Buyer opens escrow. They start doing the title work, and lo and behold, what's out there? A recorded, memorandum or a recorded agreement saying that this broker had the right to list the property. Well, you can't close then. So now you have to negotiate with this broker or pay them their cancellation fee in order to get a release of this recorded document. So that's number one. The second thing that was happening, and the broker disputes this, but what was happening is homeowners were going to refinance. Well, now you have a recorded cloud on title, and they go to refinance. Lender pulls their title report and looks at it and says, well, I'm not going to record over this. I don't even know what this is. It's this memo saying this broker wants money from you, basically. Or it doesn't say that. I mean, it says what their agreement is, but it's, the lender doesn't want to deal with it. They're not going to go and provide, financing for concern that, that's going to trump their financing. And so they, it's causing finance or refinancing to fall through. which shouldn't, because that's not a sale. That's not a conveyance of the property. That's simply obtaining additional financing or another loan against the property. Now, the broker states that a simple phone call to their office or a simple email or something like that saying, hey, we're trying to do a refinance. Will you subordinate? And then they would give a subordination, or they would even release the document and then re-record after the refinance was done. And they say, oh, that's not an issue because we would have done that. However, the agreement as it stood at the time that Florida has become involved and is pursuing a case against this broker, the agreement did not require the broker to release that memorandum, although they claim now that they've updated their agreement to add that as a provision saying that we must release that. But they claim that anytime they were contacted, that, generally or almost always, they would release it so that they could refinance. So those were the two issues that were going on. And then, of course, now Florida is involved, and their attorney general's office is involved and has pursued claims against this company, claiming under the Florida Consumer Fraud Act. They're claiming that they've, engaged in deceptive practices under that act that's, harming homeowners.
Yeah, I think there's a couple issues going on in there, and we'll get into that. Tina, have you been following this story?
I have. The interesting thing I saw about that agreement are the terms run the land. And so it's not only obligating the original homeowner to list with that company, but if they do successfully list with them and the title company or anybody else allows that to move forward, then you're obligating every homeowner for 40 years to use that company as well without compensation.
Well, yeah, in Florida, I mean, what is Florida, right? The home of retirees, I think, in a lot of places. So you're insuring, from the broker's perspective, you're ensuring your contract lives on after they've passed away, and their successor and assigns are going to be obligated to it. So it gets into probate. So yeah.
One of the interesting things in my practice of resolving title issues, which I do quite a bit of, my biggest concern is this is a 40-year contract. Well, maybe this company has a great business model and they're going to survive. But how many companies actually last 40 years?
Yeah, it feels like a lifetime contract, does it not?
Yeah, right.
Yeah.
So what happens, in year 20 where the homeowner doesn't sell it or the heirs don't sell it, and all of a sudden this broker decides they don't want to be in the real estate business anymore and they shut their doors?
Well, yeah, absolutely. And, another hypothetical would be, what if you list with this company and they want you to take a lowball offer that you don't like, and you decide you don't want to take that? Can they still take their 3%? I mean, how does that work? Can you cancel if you're being pressured to take a contract that doesn't suit you?
Yeah. And on that, we would have to look at the terms of the agreement and say, okay, what does it say as far as, during that 6-month listing, what's the homeowner's obligation? Now, the press release by the broker within the article that we read, they claim that during the 6-month listing that the homeowner doesn't have to accept anything, and they only get paid if a buyer shows up. But yeah, one of my biggest concerns is the whole, clouding of title, and, it goes under in 20 years and you have thousands of homeowners who have this on there. So what are they going to have to do to sell their property in the future? Because I doubt that the company, when they go under, maybe they will, but if you decide to close your doors and you dissolve, you're probably not going to run around and release all of these memos that you've recorded. I mean, just the recording fees alone, I mean, it's $30 here in Maricopa County to record a document. So think of, if you have 10,000 of these, that's a lot of money you're having to pay just to go and release them against all of these, homeowners.
Well, yeah. And so in Maricopa County, they have so far averaged about 50 to 52 of these recordings a month since they started here in September of 2021. So right now we're at about, the last I checked, which was the beginning of December, about 770 of these recordings. They have filed 18 Liz pendants. They have signed 7 subordination agreements and only 3 releases.
Now, with that said, with the concerns that, I've expressed if I were, representing a homeowner and looking at this, but what I also think is interesting though, is when I read the article, now I've not pulled the actual, filed copy, but when I read the article, the Florida press release was like, hey, they're trying to skirt our real estate laws and take advantage of consumers. And so, they're going after them under, kind of a vague statute of this consumer fraud. But they've actually, Florida, from what I can tell, has not been able to point to any specific law, licensing regulation that would apply to a real estate brokerage there that they're violating by doing this.
Well, and same here in Arizona. If you were to read the law, and essentially what it is a private covenant. And if you read the private covenant law, it's very vague, it's very short, and both parties have to agree to remove a private covenant. Also, what I thought was interesting about their contract is that there's nothing that says if they do represent you in the sale that it ends the contract, that it does go into perpetuity. It goes in for that 40 years. It survives even after they've represented you. So they have to, they have to actually remove it. Most title companies that I've spoken to in the Valley and regionally will not insure title with that in place.
Oh yeah, no, they're not going to insure title with that in place. Absolutely not.
I think where Florida is coming in is from an ethical standpoint. If you look at the price points in Greater Phoenix that they're working within, the documents, I've pulled a random sample, they're very low sale prices. One was $150,000. So these are not, from what I've seen so far, they're not high dollar type real estate. So it's kind of, as far as how successful of a program it is, it's not been that successful if I look at their MLS standings. But I think where Florida is coming in, this company is a member of the National Association of Realtors, and the ethics side of things starts to come into play because they do vow that they're not going to do harm, right? And if you have a seller who maybe is in a foreclosure situation, or maybe they're in a divorce situation, and this comes up and it causes harm, knowingly causes potential harm, then I think that, that might be an issue with the association. So I think all eyes are on this lawsuit.
Yeah, a violation of the NAR standards is really something to pursue with NAR. It's not really Florida's job to pursue those.
Right.
Really, if you don't like what's going on here from a state perspective, if the Attorney General and other state officials aren't happy with the way this is structured, well, to me, it seems like legislative change is necessary, right?
Yes.
That's really how to solve it. I'm not sure pursuing, some statute that doesn't specifically address this, and you're just trying to kind of shoehorn it in, versus saying, look, we now have regulatory statutes that prohibit this type of covenant between a homeowner and a licensed real estate broker, and basically make it so that by statute, the broker can't do that. But, is the Florida approach the way to go? I don't know.
I don't know, but I think what it's done is created an awareness of a loophole or an ignored part of real estate law that is being exploited at this stage.
Yeah, it's interesting. I think what they're going to confront, and what all the states are going to be forced to confront, are two questions, because you see really two issues in my mind that Florida's trying to struggle with, and that's one, do we just like the transaction generally? Does it shock the conscience kind of thing, contractual law kind of talk here? Is it so bad that this is something that we want to prohibit? And we were talking a little bit about this the other day. Like, if we were to take the numbers down and just say it didn't happen on this kind of scale, but it just happened this one time, would this be a transaction, contractually speaking, that we would have a problem with? I don't know. They'll have to wrestle with that. But two, the other big question is one of, it seems, disclosure and how they represented this deal.
Yeah.
And I know in just the article I read, there was a big question about, did you really communicate that this was going to be a 40-year lien on the property? Um, just looking at what you said, is that fair? You know, how was it communicated? I think as a general rule, we've seen this already in Arizona with some of the changes to our wholesale laws. Laws are going to be moving towards pro disclosure on this. It's not going to be going the other way. So,
Yeah. My question is, can you obligate a future homeowner to use you under this agreement without compensation? So once you hold the original homeowner accountable for their contract, okay. But can you really expect another future homeowner to now be obligated without any additional compensation to them? That's my question.
Well, and that's why they record the document. So if it uses the language runs with the land, then anybody purchasing the property or acquiring it is deemed to acquire it with knowledge of this existing agreement and the obligation to perform. It's just like CC&Rs, right? If I go and buy into a property, I wasn't the original homeowner when the CC&Rs were passed, but I go and I buy into the property. There's going to be CC&Rs out there, and they're going to say how I can use my property. And if I go in there and I buy it and start using it in a way that's prohibited by the CC&Rs, they can come and say, well, you can't do that. And I can't say, well, I wasn't here when you guys passed these. And they say, no, it was recorded and you knew what you were getting into when you bought the house. And I think that's probably the argument that this broker would make, which is, well, you kind of knew when
But
you acquired title.
But yeah, are you harming the seller by enforcing this and refusing to remove it, since everybody has to agree to remove it? You know, and I'm not saying they wouldn't,
Mhm.
but it's just, I think what we're discussing are the holes in the contract that do not benefit the other person who's agreeing to it, which is the homeowner.
Right. And one of the things that we have, both in ethics and by law is the idea. Now, this would be a dispute between the seller and the broker potentially, but let's say another broker was involved and, listed it and sold it. You're technically not supposed to allow a dispute between two brokers as far as who gets what commission to impact a sale. Now you can, later go to arbitration or mediation on the issue and things like that. So that's one thing to also look at, as well as, whether or not, how that would play out if another broker became involved and then that dispute arose. So
Really interesting.
Yeah, and if anything, this should be a lesson that any time, well, nothing is for free in this world. If it seems like you're getting or somebody's offering to pay you something, but boy, wrongfully or rightfully, anytime somebody records a lien against your property, boy, the red flag should be up. That is not something, even if you volunteered it and you didn't know what you were getting into, the process of removing that, we know full well is a process.
If they're having a notary,
Yeah.
if you're signing something and there's a notary involved, I don't know. I think my eyebrows would go up. Like, is this not just about the $1,500 then?
Yeah. Yeah. No, good point. Because you need the notary to record, right? You know,
Yes.
something more important and significant is going on than just the exchange of money here.
Yeah.
Yeah. All right. With that, let's move into the Arizona housing market specifically. So Arizona's a hot state, temperature-wise, and so we like to talk about how hot it is and brag about it. But so let's take a temperature here. We've just gone through 2022. A lot's happened with the real estate market. What's the temperature of it right now? Where are we at?
Believe it or not, we went from a red hot seller, the highest the Cromford market, well, not quite the highest the Cromford market index has ever been, but second highest that it's ever been, probably, compared to 2021, which was higher. But we went from an extreme seller market, and within about 6 months, we went into a balanced market, and then we glided into a little baby buyer's market for literally maybe 3 or 4 weeks. And over the last 2 or 3 weeks now, we have actually started to see a bottoming out, and the Cromford Market Index, which is our index that we watch for heat, if you will, has been moving back into a balanced market, which basically, in comparison to where we came from, feels extremely cold. You know, all of a sudden, buyers have time, they have negotiating power, they have options, the homes look better, they're not, dilapidated. So to have that all happen within literally a matter of months is extraordinary, for sure.
Yeah, and I think perspective is everything.
Mhm.
There's a lot of real estate investors that were born in the boom market, right? And maybe didn't experience the last, the Great Recession that we all called it. So
Mhm.
why don't you kind of give us some perspective, overlay kind of what that looked like in its early stages and how different this is?
I think the best way I can describe the difference between the 2007 through 2009 crash, which was a drop of 55% in price, to today, is just looking at the raw numbers of where we were prior to that crash. So in 2007, the Cromford Market Index, right around October, hit the lowest measure we've ever seen, which is 26.5. What does that mean? It means we had 57,000 active listings in the MLS, and we only had 4,000 under contract. That is where we were before prices started their crash, okay? And that was right around the beginning of the foreclosure crisis that started to see that added inventory not only being added on from lenders, from investors who were letting their properties go to foreclosure because they had made their money on them. And also on top of that, you had an excessive amount of new construction that was hitting the market because they had basically built too many specs. Okay. So that's kind of where we were in 2008. Today, we have 16,000 listings in the MLS. We have just under 6,000 under contract. So when you look at the indexes, the way they are, we always look to see what's normal for this time of year. Is 16,000 in the MLS normal for this time in December? And same thing for under contract and combining closings and all of that. So our demand line has what's under contract, which is pending UCB, CCBS, all of those contract statuses, and also closings. And then we look at that to say, are we now within normal for December? And the fact is that both of them are below normal. They're about 20 to 30% below normal still, but both indexes are close together. Does that make sense? So when both your supply and your demand are going down together, but they're close together, you can be in balance. We don't like it as an industry because we get bored if demand specifically is below normal. So what you're seeing in the reporting is primarily on the demand side. So the last thing I saw in terms of, I think it was a Redfin predictions for 2023, they stated that demand was going to be as bad as 2008, which makes everybody think that means we're going to see prices go like 2008. Well, the reality is the prediction is true. We're already at 2008 level demand, sort of, but 2008 was rising at that point, but it's still extremely low for the industry. But the fact is that our supply is not at 57,000. So that means with the supply actually so low and declining right now, not just seasonally declining, but actually for the season, it's declining sharper than it should. You're seeing less downward pressure on price, and you're seeing a little more of a balanced state.
Do you think we're not seeing the supply because of interest rates? Meaning, you look at your house now and you think, well, yeah, I might like to swap houses and I might want to upgrade or even, downsize. But I look at my interest rate and it's so good right now
Yes.
that I'm not willing to list the property for sale because if I go and swap houses, I'm paying I'm doubling or more my interest rate.
Mhm.
Why would I want to do that? Do you see that maybe sellers are, staying on the sidelines because of that interest rate situation?
Partially.
Okay.
So one of the interesting things that, we've tried to get across to people is that what also contributed to the 2008 crash was the lack of choice for sellers that had to sell. So builders had to sell, or they actually rented some of them out, frankly. But if they couldn't rent them all out, they had to sell them. You had people going into foreclosure, or the banks had no choice but to sell these homes. Banks are not going to be landlords. So the big difference between 2008 and today is sellers still have power. They still have choices. They could, if you've got a sub 3% mortgage, right? Say your payment's $1,
Yeah. Okay.
um, and you can't pay your dollar. Maybe you've lost your job or things are going rough. The fact is, you could find a tenant that would pay your mortgage payment because rents are still so much higher than the payment that you acquired even last year or the year before. So if you were to do that, you have that choice. You would undercut every other landlord in the subdivision most likely, and you would get a tenant, and you would be able to make your mortgage payment and go live with a friend or family member, right? So not saying that that's going to happen, but I'm just saying that the sellers are not in distress. They can wait, or they can rent, or they can rent it out for a weekend for the Super Bowl. They have choices, and that gives them a level of power that puts less downward pressure on price.
Do you remember? I'm just curious. I don't, but when I think about it, I'm thinking 5-6%. Where were we in 2008 when this crashed approximately on interest rates? Do you remember?
Well, I would say probably about 6%,
Yeah.
in the 6% range. Yeah, before. Okay, so another thing that happened back then is the rates started to come down, even though the prices were coming down.
Mm.
But by that point, once the foreclosure crisis started, then people's credits start getting wrecked, and they're out of the game for 7 years after foreclosure, right? So the mortgage rates went from 6% all the way down to like 3% by 2011. But it didn't actually increase our demand because nobody could qualify at the 3% because they all had wrecked credit. So even investors couldn't qualify at the 3% because they're investors. So what we saw, even though we had the lowest mortgage rate in 2011, we had one of the highest percentages of cash sales because that was the bottom of the market and everybody was buying homes for $1 anyway.
Right.
So they didn't care about the interest rate.
So we've, from an interest rate perspective, we've almost flipped the script, meaning here we had really low interest leading up to the cooling
Mm-hmm.
versus back in 2006 time period leading up to the 2008,
Mm-hmm.
we had higher interest, and then all of a
Yeah.
sudden the interest rate started going down. So it's almost like it's flipped,
Yeah.
which, to your point, allows now sellers to have more choices. Because if back then, if you had a house worth let's just say 400 at 6%, that's a hefty mortgage that you're paying.
Mm-hmm.
And your ability to then find a tenant who's willing to lease the property and so you can break even isn't there. So then your choice is put a tenant in there and cover the difference every month, or let my house go. Versus now, well, my mortgage payment's so low because my interest rate's so low, I can put a tenant in and break even or cash flow. Why would I let the house go?
Right, exactly. If you were in a stage of distress. And I
Right.
think that also the fact is, there were two different things going on, both our markets. If you want to talk about the 2005 run up in price compared to the 2021, 2022 run up in price. The one factor that is the same is Wall Street. So back in 2005, Wall Street started investing in mortgages. And when they invested in mortgages, they increased the level of risk extraordinarily, right? That's where we got all those crazy loan programs. And so when we look at who took on that risk, Wall Street took on some, but the lenders took it on who the loans, and the people who gained the loans took that risk on. So when it all fell apart, everybody who had been involved in that type of activity with those crazy loans, which we won't get into, felt that. This time around, Wall Street came back into our lives, but since lending's regulated now, because that's what happens when you have a big old party and your crazy rich friend comes, with the tequila, and then the police shut it down. So the police got shut down, came in, and then we got Dodd-Frank right after that.
Right.
So this time around, they came back, flood of money, but now that they don't go into mortgages, now they're buying the homes themselves, either as a long-term landlord or a short-term flip. And once again, we were all having a pretty good party from 2015 to 19. Our crazy rich friends come with the loud music and the tequila, and the rest of us, they pushed the regular owners out. Because, once we went beyond affordability in our metrics, like, whoa, red flag, people can't afford to buy that back from you now. They can't really afford to rent that back from you now. And we're just watching them. We're all drinking water now at the party. And they're like, they kept going. They just kept buying and selling amongst themselves. The short-term hold Wall Street back, like the Open Doors of the world, not to pick on them, but they're the biggest one here. And then you have your large, Wall Street backed investment firms like Invitation Homes and American Homes for Rent, et cetera, all having a big old party, pushing the prices up because they do not care about affordability, because they don't care about appraisals. They have a bunch of money. They have marching orders to go buy homes, right? Well, who was taking on the risk? Not the regular homeowner. They were pushed out. So when we have this correction now, the people or entities that are shouldering the loss are the ones who took on the risk in the first place. That is a big deal. So who's been shouldering the loss of the last 6 months? Short-term Wall Street investors, Open Door, Zillow, Redfin, and OfferPad out here. Redfin's not very active out here. So it's really was the three. And then Zillow got out, probably the smartest thing they ever did after they lost hundreds of millions of dollars. And then we all know what Open Doors' third quarter results were, which was $920 million. That's what happens if you ignore the population and what they can afford. We had a couple of, locals that they took on some losses. They held their properties a little bit too long, but the vast magnitude of losses isn't even OfferPad. It's for sure Open Door and they're still trying to unload those vacant properties.
I wonder how much also is involved in the sentiment of the seller. Going back to the last recession, I'm sure it didn't happen as quick as I remember it, but boy, I mean, it felt like properties were 50% underwater, and it felt like it was overnight.
Well, big difference again. Today, the vast majority of sellers have in the MLS, the last I checked, of the non-new construction in MLS, 65.5% of those sellers have owned their home for at least 2 years or longer, which is huge because now you're looking at their appreciation rate is still anywhere from 30% all the way up to about 75%. So the only people that are truly unhappy about this are only those people who have to sell today and they have only owned their home for a year and a half.
Yeah, there was, there are some folks that are victims of circumstance and can't decide otherwise. But during the last crisis, it was common for both Sean and I to meet with folks that actually did well, made good money, and were just kind of in the sense of despair in that, look, it's dropped so much. I'm not going to be out of this forever. So I might as well just take my lumps and go. There was that kind of feeling. But now the decline is much more, how do I put this? Much more planned in the sense that you have, obviously you had it reach levels that require a correction probably, and that can happen in a natural market. But we also have this thing out there called the Fed. And the Fed has basically all but come out when inflation started to get out of control and basically said in kinder terms, we're going to wreck the economy. We're going to raise interest rates. That kills demand. That's basically what that's designed to do.
Your party was too loud.
Yeah. So we're going to adjust this, and we hope we can do it in a way that does the soft landing, all of that kind of stuff. But they've been doing that. But to the seller, it's like, okay, well, now I know this isn't some, catastrophic burst that happened that I can never recover from. Now I'm just
Mhm.
waiting for the Fed to do its thing. How
Yes.
much of that does that sentiment play into this, do you think?
I think again that just leads into the fact that sellers have choices. They're not desperate to sell. They have the ability to do other things if they want to. For those sellers that have properties that are not in perfect condition, they may decide to spruce them up a little bit, uh, and get them more competitive in the marketplace. But I think yeah, the seller sentiment is such that say for instance, if I've owned my home for 5 years or more, which is not an unreasonable amount of time. Um, yeah, if I had sold in May at the peak of price this year, I would have made 85% on my home. Now I make 75%. Oh, well. That's kind of can they afford the concessions? We've gone from 60% of sales in June went over asking price to now 49 to 50% of sales today having a concession involved, with a median concession of $9,300, which is about in line with the rate buy downs that they've been doing, temporary and permanent.
So what about things like foreclosures? You mentioned them. Have we seen an uptick in foreclosures? Has your
No.
reporting seen that? No?
No, we're not expecting anything like that, not at this stage of the game. Mainly, we look at the notices of trustee sale, which is the 90-day, right, advance notice, and it's flat. It popped up after forbearance was over, but it was still extremely low. We're still seeing, notices of trustee sale, the numbers are now below, they still are below where we were in the 90s even, and our metropolitan area has grown exponentially since then. So we are extremely low, and the ones that actually make it all the way to foreclosure, I could count on two hands for the most part.
So forecasting out in 2023 and beyond, where do you think we are at in this market cycle? Understanding that we have factors out there that we can't control, like a
Yes.
Fed, you know.
Yes.
Now we have interesting, just bringing up the Fed, there's macro experts that I follow occasionally are always looking at, okay, at what point is there a pivot? And a pivot doesn't
Mhm.
necessarily mean going back the other way, but it can mean a change in course. And most
Mhm.
recently, they increased the interest rate by 50 basis points, but it had previously been 75 basis points.
Mhm.
Now whether that's a pivot, who knows, and whether that will be a trend of tapering that off over time, who knows? But where do you think we're at kind of in the cycle?
I think we're at a very interesting stage right now. When we talk about you talked a little bit about, feelings and how sellers and buyers both feel. Neither sellers nor buyers like to do anything when they are feeling uncertain. And so whenever we have those PTSD, because many people still here did experience a foreclosure in 2008 and they get that feeling all over again. That's where I basically say we need to lean into the math. You have to lean into what we know. And what we're leaning into, what we're realizing is that we dipped into this little baby buyer market for about 4 or 5 weeks. In the last 3 weeks, it's starting to move up. So what that means is any contract that's written today, you will not know if that was the lowest contract accepted for 3 or 4 months, and that's what many people don't realize. You have to wait 3 or 4 months to realize that that was the bottom of the market, just like sellers didn't know in May when they closed that that was the top of the market. They had to wait for all of May to close, and then, actually, yeah, all of your April escrows had to close in May, and then you have to compare it to June and July. June wasn't that far lower, so they were like, "Well, not sure, not sure, not sure," and then boom, come July, you're like, "That was the peak," and then everybody gets on. By the time you find out that was the peak of the market, you're now reducing your price, you're now doing concessions, you're more days on market, you're late to the party. Same thing on this side of things. Um, the contracts written today will close in January. We won't know if that's the bottom until we compare it to February, and if February is not that far off, then we have to wait till March. And by the end of March, which is reported in April, by the time you realize, "Oh, January was the bottom, I'm gonna get in," those contracts were written 4 months ago. That party's over. The chips are done. You have to watch the math. And if this continues up, and then, which interest rates, we don't know what they're going to do, but if they do drop down, which they've been doing lately, that could mean that that buyer market was over, but people are still in the mindset of it's a buyer's market. You know what I'm saying? So you're going to see certain things like rate buy downs stay in our lives for 2 or 3 months, I believe. But you're going to see a lot more listings coming on that look really good and smell good in good spots that buyers might just be like, well, I feel like it's risky, but I will take the risk for that house because it meets all of my needs now. Does that make sense?
Sure.
So once that starts happening, they realize that it's attainable, that they can possibly, qualify at the higher rate, but then get a buy down that temporarily lowers their price or their payment for a year. It might be just enough to get many of the, younger people off the fence and start at least looking. So I have a feeling that seasonally speaking, if we want to hang on to anything that's certain, that's what we're trying. We can't be certain about mortgage rates. We can't be certain about a lot of things, but we can be certain about how the Cromford Market Index is moving, which is a non-seasonal, seasonally adjusted indicator that tells us that we are not plummeting into despair. We're just hanging out there. We can say with good feelings that we're going to have more contracts in the first quarter of 2023 than we had in the last quarter of 2022. I think that's safe to say. So because seasonally that happens in every first quarter, that's our buyer season. And you will see more listings come on, and you will see price reductions take off in the first 3 weeks of January. So you're going to see a lot of interesting things that might get a lot of these buyers off the fence and start talking to their lenders again. Some of the uncertain things, if Wall Street comes back, into our lives, that could, again, that puts more risk in the marketplace and you could see prices rise again. There is a legislation, though I don't know if you have seen it yet, but at the end of October in the House, federal, they introduced the Stop Wall Street Landlords Act, which is, who knows what it's going to look like when they're done arguing about it. But the premise is to take away certain tax deductions, to take away certain federally funded mortgage benefits or what, I can't remember what it is, financing, and also to add on an excise tax on the sale of those properties by certain, quote unquote, certain large investors, which always makes me a little nervous because I'm like, you can't really name an investor, but then you have to make a definition. And once they start defining investors, they may or may not be Wall Street backed. I'm not sure what it's going to look like. But the fact is that, again, we had a party, the music got too loud, prices went up too high, and now you've got the police came, shut it down with the Fed, and now, again, you're looking at regulation. So if Wall Street gets regulated again in housing and they hand the market back to the regular owner-occupant, what you will see then is more of a stability into the real estate market once again, because then you have to be affordable. You have to have incomes to, justify, and people are spending their own money. They tend to be very conservative with their own house over their own head with their own money. And so most likely we won't see big swings like that. Hopefully that helps.
Well, and that's interesting because, I have a 19-year-old and I always think about how is he ever going to afford a house, and especially with today's prices. So in essence, potentially by this regulation, they're trying to, pull them out of the market or make it so that, they can equally, the regular homeowner can equally compete with these Wall Street firms who up until now have had unlimited resources and, like you said, could pay whatever they want. So do you think legislation like this will have the effect of creating a little bit of depreciation in the market?
I think the depreciation we're going to see has already mostly occurred. And the Wall Street firms that engaged in that activity have been hurt quite a bit. And so
Mm.
right now the sellers, regular normal sellers, are choosing not to compete with these quote unquote desperate sellers and like iBuyers specifically. So for instance, let's just pick a certain large iBuyer in town, right, with a lot of inventory that they need to unload. If that investor decided to list every single one of their properties for $1 in December, right? And they sold them all and they all closed in December or January going in next year, you would see a massive drop in our dollar per square foot or, in our overall sale price lines. But then once all their inventory is done, all you're left with are people who don't need to sell their home for $1, nor do they want to, right? So you would see then an increase, like almost like a bounce, if you will. So one of the things is we have to look at how much of this inventory from short-term hold landlords, not long-term hold, short-term flip models, or you could argue that's more speculative models. How much of that inventory do we have to move through before we get back to a stable base of inventory? And I would say not a lot. Not a lot of that, because back in 2008, we had a lot of that, whether it was new build or we had it through, foreclosures, tens of thousands of them, hundreds of thousands of them. We only have maybe a few thousand of them, which, as I said, if mortgage rates come down, all bets are off on how long this market's going to last and how long these opportunities are going to last for buyers who can shoulder the rates.
What about factors like consumer debt, credit scores? I know that's probably an indicator that's followed to determine what this is going to be, but maybe given the nature of the market and where it's at, supply and demand, maybe we just go sideways for a while and we've seen our bottom. Who knows? But there's other areas of the economy that take out buyers. With the rising interest rates or whatever else. And somebody I was following regarding auto loans, for instance. Auto loans in the last couple of years had huge appreciation. And now you're seeing depreciation on a lot of those ones where they had to go get a car and they did that and they got into huge auto loans. And are you seeing, has there been any indicators that you follow at what the average buyer is in terms of like credit scores? Has that been dropping or anything?
I haven't looked at that analytic recently. However, I have looked at the analytic that measures credit availability in mortgages,
Okay.
which is generally a reflection of how tight or loose lending practices are going. And so after forbearance, lending practices got tighter. And then we waited after forbearance to see if they would loosen up, and they never did. And now they've actually, with the Fed fund rate hikes, we've actually seen it get even tighter. So you could argue now that lending practices are as tight as they were in 2008 through 2012, which means that you have to have a very good credit score. You have to do all your paperwork. If you're self-employed, it's going to be, a lot of paperwork and a lot of and what's the word I'm looking for? Not speculation. They're going to be stricter on you. So I would say lenders have gotten very, very conservative in their approach, which means that there may be fewer people who can qualify, but the ones who do qualify are strong. And so far, what we've seen in relation to the mortgage rates on the Greater Phoenix contract activity every week is what I look at. I look to see where are the rates. Are we seeing any kind of recovery in our contract activity? And this is a low time anyway, so it's a little harder to show. But we have seen a notable impact whenever that rate drops by a significant amount. We see a boost about a week or two later in the number of contracts accepted. So we know that the buyers are there. We know that they have pretty decent credit scores, lots of them. Even though we have a lot of people who don't, we keep growing as a metropolitan area. So even if your median stays the same, you have more people above that median that can afford it, and you have more who can't. Does that make sense?
Sure.
But the fact is that we have a lot of people with very, very good credit that are waiting just for either the rates or their situation to shift just a little bit to where their affordability is within range, and they'll be back in the game.
Interesting. I know it's impossible to predict a bottom, just like it's impossible to predict a top. And an investor probably shouldn't even worry themselves too much about doing the impossible. But for those of us who have PTSD from the last recession, it seems like there might be a lot of investors potentially missed the boat waiting for the sequel to the Great Recession,
Yeah.
and then just not getting it. You know what I mean?
Mhm.
Like, well, we're only down 30 or 20% until we're down 50 or 60. You know, it's
Well, it's not even investors. It's even the buyers. Buyers always say they want to wait till buyer's market, but what they don't realize is that what comes with buyer markets is uncertainty. So the thing is that most people wait for the certainty to come and then they start to leap. So people who take on the most risk, of course, tend to reap the most reward or the biggest loss.
Sure.
You know, so the fact is, it all depends on your risk tolerance. But here's what I usually tell buyers, whether they're investors or not: is it okay if you're close to the bottom? Does it have to be the exact bottom? You know, because if you're only the price, what you're not seeing is the cost to the seller underneath the price on the cost sheet. That is what's going up. So, for instance, the last I checked, our median sale price in the MLS was $420,000. If I were to adjust all of those prices with concessions, with a median concession of $9,300, my actual median, my real median's $411. And so if you're only watching the 420 and going, but if I could only get 411, well, you're done. You're watching the wrong number. You have to be involved in the entire marketplace and understand what's happening in terms of seller concessions, what they are agreeing to repair, what they're agreeing to contribute to in closing costs, which can be significant. So I'd say that, again, if all you're watching is price, that's a lagging indicator, which we've been criticizing Powell for watching price, because it's a lagging indicator that you will not see your results for months after that period of time is over. So we can tell you from 2010, we had a little baby buyer market, which nobody talks about the baby buyer market of 2010, do they? Where we dropped by 8% in price.
Yeah.
Nobody talks about that one because it was not dramatic enough. This was very similar. And if you look at 2010, the negative headlines on annual appreciation rates went negative for 8 months after your buyer market was over. So right now, Redfin is predicting, which is valid prediction, which is what I'm going to be predicting as well. Going forward, even if our prices went flat, just went flat right now, even up a little bit, it doesn't matter. For at least about 8 months, we're going to see negative over returns, because last January of 2022 is going to be higher than 2023, and then February and then March and April, all the way up to the peak of May, which is about 11 or 12% drop right now. So even if we went flat, you're going to see all the way to May, and then even pick in June and July on the way down, you're going to see 8 months of negative year-over-year headlines for Greater Phoenix months after the buyer market was over. So again, that's why, you can't really go by that. What is it that McCain said? I think he quoted somebody else. It's always darkest before the dawn.
Yeah.
So when everybody is feeling despair and that it's never going to happen, and their home's never going to go back up, this is it, then that's generally where your opportunities lie.
Very interesting. Well, Tina, thanks so much for being with us. We really appreciate it. Tell our listeners where and how they can find you.
Well, I'm terrible on email. I'll tell you right now. It's a nightmare.
Don't email Tina.
Don't email me if you need a response right away. I'd say I'm a little better on text, but probably the best thing is, hopefully you don't need a response right away, but tina@cronfordreport.com is my direct email. And my business partner, Michael Orr, the founder of the Cronford Report, is still very much a part of the analytics and all of our written commentaries. You can email him as well at mike@cronfordreport.com.
Great. Well, thanks, Tina, so much for joining us. We appreciate it. It's been great. Hope to have you again. With that, everybody, make sure to join us next week. We're talking knowing the ropes, working with a closing attorney on creative financing. Look forward to seeing everybody next week. Have a nice Christmas. We'll see you then.
Have a good afternoon, everyone.